All right, everyone, we're back. Make sure your camera is on. Any questions you might have regarding the first half, drop them now in the chat. YouTube is live. Good. If you're watching on YouTube, let me know that you're there so I can address you while I teach. And if you have any questions, also drop them in the YouTube live chat. I have it open and I'll address it. Right. Good. I think I got everything. Okay, cool. So let's see who we got. Nidia is here. Felix, Jacqueline, Landra, Brittany, Nina, Elda, Malin, Benjamin, Olga, Amy, Arlene. Kind to see you, Arlene. Kind. I see you. And Vanessa. All right. All right, so we're going for the second half or part 2 of real estate finance. Again, taking our sweet time, making sure everybody clearly understands everything that we're going through in this chapter. It's a lengthy chapter. We are on page 7 of 29 pages. Some stuff is going to get a little faster. We're going to go through a little faster. Some stuff I'm going to stop as much as I can. So that's why I'm breaking this again into 2 days. So initiating a mortgage loan, loan application, mortgage loan underwriting. Now, to do the application, most lenders use some type of version of the Universal Residential Loan Application, or the 1003, which was created by Fannie Mae. We'll talk about Fannie Mae better on Monday, but Fannie Mae is the one that kind of like rules over all the other banks. So Fannie Mae says, I buy stuff, and because I buy stuff is my way or the highway, and most banks adjust to whatever Fannie Mae says. Again, Monday we'll go over this. In this form, it requires the borrower to provide information about the property and the borrower. In addition, the application must exhibit supported documentation as indicated in the below exhibit. In the following exhibit. So when you apply for a loan, any type of loan, they ask you a bunch of stuff. They ask you for your age, your employment, your assets, your education, your monthly income and expenses, your debts, your blood type. Do you have kids you want to offer in case the loan doesn't get approved? Do you have a neighbor that you don't like? Throw them into the loan, right? They ask you for so many things. And if it's for a property, this is just loan application in general. If it's for a property, then they're going to ask for the age and the year of the property, what was the original costs, when it was acquired if you're refinancing, and what's the current loan balance if you're refinancing. Also, they want to make sure they get an appraisal report, which by now you guys know how appraisals work. A certified appraiser comes out and says, this, in my opinion, professional opinion, this is what the property is worth. Felix is like, kids? Yeah, they don't ask for kids or blood type or stuff like that. You never applied for a loan before? It's like in the in between the lines, there's like one of the check boxes that you did not pay attention to. It says that you're giving up your firstborn in order to get this loan. You never seen that? All right. But they also ask you for the purchase contract to make sure that you're serious about what you're buying. They check your credit report. They verify your income, and they verify your employment, right? So very, very important you guys have all this stuff in order before, at least these right here. I mean, your information you should know. But these right here should be in order before you do anything else. For you to get the loan, you should start with a pre-approval. And the pre-approval includes what's here and here. So the borrower's information and credit report and income and employment verification. Everything else will come once you identify the property. So the appraisal, the purchase, the appraisal, information about the property comes after. Okay. Mortgage loan underwriting. What is underwriting? Risk assessment. Underwriting is risk assessment. Okay? And don't worry, it's written right here. Loan underwriting is the process of assessing the lender's risk in giving the loan. So underwriting, loan underwriting, or any kind of underwriting, the word underwriting means risk assessment. It means somebody is analyzing all the information you provided, according to what we just went over, all the information you provided, and they say, I don't know if I should lend to you. Or, yeah, you're good. So they look at you, they look at the papers. If everything matches, that's it. You're getting a loan. If something's a little iffy, they might give you a loan. They might not give you a loan. If you don't meet their guidelines, they're not giving you a loan. Simple. That's underwriting. What is the risk of me lending to you? Or the risk of me insuring you if it's an insurance policy, right? So they're going to check out your ability to repay the loan. They're going to check out the value of the property to see, wait, I'm lending you $200,000, but the property is worth $150,000. I don't think so, right? So they have to figure out the value and also determine the terms of the loan according to what they found. Qualification. A lender assesses risks by examining or qualifying both the borrower and the property, as I just said. In qualifying the borrower, underwriter weighs the ability of the borrower to repay the loan. We just covered that. That requires an analysis of whether the borrower's income, cash resources, creditworthiness, net worth, and employment meet the lender's standards. Notice it says it meets the lender's standards. What does that mean? As some of you were asking me earlier, which is better? What should we do? Well, it depends on the loan you're getting and how they're approving you. It's up to the lender. See, we're going to talk about it on Monday, but an FHA loan is issued by the bank. A VA loan is issued by the bank. A conventional loan is issued by the bank. So technically, all the loans are issued, almost all the loans are issued by the bank. So it's the lender's standards that you must meet. If you don't, and from Bank of America to Wells Fargo to TD Bank to Chase, whatever, from bank to bank, they have different guidelines or standards. So they'll approve you where one bank says no, the other one might say yes. Do you guys understand where we're getting at? Okay, great. Now, what the bank will give you, and I answered that question before because Nina asked another example. What the bank will give you is a loan to value ratio, right? That means they'll give you a maximum loan against the purchase price. They don't give you 100%, or in the past they did. Some lenders still do, but the majority of the lenders give you a percentage. That means that the difference between what they give you and what you must bring is called down payment. We covered this right before the break. And we have right here again. So LTV or loan to value ratio, LTV or loan to value ratio, is pretty much this. We have appraised value which could be purchase price, right? And then we have the maximum loan amount or loan to value. So appraised value or purchase value, right? There's a loan to value. That's loan to value. And we have down payment. Appraised value minus loan to value equals down payment. If they tell you, hey, you have to come up with 3% down payment, right? If you have to come up with 3% down payment, then appraised value or purchase price minus the down payment, the 3%, equals loan to value ratio. So these two, the bottom two, they are interchangeable. If they give you one, you can figure out the other. It's always based on value. 90% of the times, the purchase price is the appraised value. Okay? 90% of the times, the purchase price is the appraised value. So, value, we're going to assume 100%. It's an assumption. Okay? 100%. LTV, let's say 80%. Down payment is then 20%. 20 plus 80 equals 100. It could also be the other way around. And I'll erase this in a second. It's just to show you here. It could be the other way around. Like I said, it could be value or purchase price 100%. They can say down payment is 3% and your LTV is 97%. Again, 3 plus 97 is 100. It always must meet 100% of the value. Okay? Any questions on this? Nope. Let me know if you have questions. All right, cool. There are no questions. Qualifying for a mortgage loan, and most of the stuff we're going to run right through. There's only one or two things here that I'm going to stick to that's very important to address. Equal Credit Opportunity Act, we're going to have a chapter. We have a chapter on discrimination. So Equal Credit Opportunity Act means that everybody is equal, meaning everybody is entitled to apply for a loan. If your financial qualifications do not allow you to obtain the loan, then hey, we did not discriminate. You just don't qualify, right? But if I deny a loan based on race, color, religion, national origin, or anything like that, then that's illegal according to ECOA, Equal Credit Opportunity Act. Okay? That's why you shouldn't fill out the survey. You know that little portion. There's a portion there that they say, hey, it's just for information or census purposes or whatever. It doesn't affect your loan. Always say that you're a white male and that's it. Okay? You'll get qualified on the spot. You guys some of you are smiling, but this is so true because it's for information purposes. Listen, it's not. I'm not telling you to commit fraud because it says there it doesn't matter. It actually clearly says when you open a checking account, when you apply for a credit, it says it doesn't matter. It's for informational purposes only. You don't have to reply. Right? So if it doesn't matter, can you lie on that one? Right? Right? Simple. You can. As a matter of fact, for instance, I could put whatever I want. I can put whatever I want. You can put whatever you want. You know why? Because what we are today doesn't mean that's what our generation before was. We're such a mix by now that we can be anything we want. Right? If I want to say that I'm Chinese, guess what? I'm Chinese. Simple. I don't know. Maybe 100 years ago, I have somebody in my family that was Chinese. I know I have Indian. That I know. Indian, French, African, everything is right in me. So much that my skin just rejected color, didn't know where to go. That's why I keep on adjusting the settings here so I have some type of color. Otherwise, you guys wouldn't even see me. It's terrible. You see just a shirt hanging over here. You know? So I can put whatever I want. Do that. See how you get approved for everything right away. It's for census purposes only. Right? Anyway. Alright. Let's go over this. Equal Credit Opportunity Act, I'm going to skip because I just addressed that. Talking about my transparency, my Casperhood. Qualifying the borrower. How do we qualify the borrower? Obviously, we're going to rely on these 8 types of information. And again, I think you guys already heard most of this. Your current income or assets. Your current employment status. Very important. Do not change your employment status until you close. Right? After you close, you want to lose your job, you want to move to another job, whatever you want. But if you are approved based on your current employment status, do not change. Your credit history, very important. How do you handle your debts, right? Your credit cards, if you have any collections, if you are up to the limits, all that weighs on you, right? Monthly payment for any existing mortgage or the current mortgage that you're about to go into. Monthly payments being made for other loans on the same property. Monthly payments for other mortgage-related expenses or other debts. And also monthly debt payments compared to monthly income. This is called debt-to-income ratio or DTI. If you guys ever hear DTI, is debt-to-income ratio. And there's front-end ratio, and there's back-end ratio. We're going to talk about that in a second. So DTI, debt-to-income ratio. What is a qualified mortgage? First of all, what is a mortgage? Let me know in the chat. What is a mortgage? What is a mortgage? Everybody should know by now. That's what mortgage means. That was a good one. That's not what a mortgage is, but that's what a mortgage means. Olga for the win. House. What is a mortgage? House. But thank you. I appreciate you guys. That's exactly what it means. But it's house. It's collateral. Absolutely. Yes. So what do you think? What do you think is a qualified mortgage? What do you think is a qualified mortgage? If the mortgage is a collateral, right? If a mortgage is a collateral or the security, that means that between the collateral itself and your financial qualifications, this is an okay mortgage. If you guys read, means that it meets the ability to repay requirements. That means it appraises, right? It appraises and you financially can afford it. That's a qualified mortgage. Now, the issuing or giving a qualified mortgage gives the lender certain legal protections in case the borrower fails to repay. We already covered this. For instance, if you don't pay the mortgage back, the mortgage loan back, they can take your house. What is generally not allowed in the terms of a mortgage loan, what is generally not allowed is an interest-only period when interest but not principal is being repaid. Negative amortization, that's when interest increases over time. Balloon payments, larger than normal payments at the end of the loan term, or loan term longer than 30 years, or even excessive upfront fees and points. These are generally not allowed. There's not impossible, right? Not completely denied and not illegal. What we said is generally not allowed to be in a qualified mortgage. So if it's a qualified mortgage, can we get a little bit more creative? No. Qualified mortgage is what it is. You have the ability to pay. If you're that close and you really want the property, let's see if we have other options. So we'll charge you fees and points up front to reduce the interest and now makes you qualify. We might be able to extend from 30 to 40 years and now makes you qualified. Like loan modifications usually do that. We might charge you a lower payment amount. We're going to go over this in a second, right? And at the end, you have a larger payment because you're not fully paying it off. Negative amortization, again, instead of paying down the debt, you're increasing your debt over time, and so on. What is generally required for a qualified mortgage? Generally required. This number can vary. Okay, this number can vary. But what is generally required is that your monthly debt is no more than 43% of your monthly pre-tax. So gross income, right? What is generally required is that your monthly debt does not exceed your gross 43% of your gross income. So we're getting to DTI, to these numbers, and I'll help you calculate in a second, okay? Qualified mortgages include loans that can be bought by Fannie Mae or Freddie Mac or insured by certain government agencies such as Department of Agriculture, even if the debt ratio is higher than 43%. Don't worry about these. I'm going to talk about it again towards the end of this chapter. Talked about this. We talked about this. Income qualification. Income qualification. So we're going to start with income ratio and figure out what's your DTI. Ready? DTI, income ratio. The income ratio or housing expense ratio, so income or housing expense ratio, establishes the borrowing capacity by limiting the percent of gross income that a borrower may spend on housing costs. Housing costs include principal, interest, taxes, and homeowners insurance, and may include monthly assessments like mortgage insurance and utilities. The ratio formula is PITI, which is your monthly principal, interest, taxes, and insurance. That's your housing expense. PITI divided by your gross income equals income ratio. Again, I'll throw numbers at you in a second, okay? Nina's asking, are the loans longer than 30 years? Traditionally, no. But under certain circumstances, they could be for 40 years. So land usually could be for 40 years because it's very well secured. Land is land, not going anywhere. Okay? But if it's residential, 30 years. When you do a loan modification, they might extend to 40 years depending. So it could be. Now, to identify the maximum monthly housing expense, an income ratio allows to identify the maximum housing expense that an income ratio allows, you modify the formula as follows. So monthly gross income times the ratio, and you get to know how much mortgage can you afford, right? How much PITI you can afford. Most conventional lenders require that this ratio be no greater than 25 to 28%. In other words, the borrower's total housing expenses cannot exceed 28% of gross income. For an FHA-backed loan, the ratio is 31%. And for VA guaranteed loans, they do not use this qualifying ratio. So here's an example. It says, if a couple, and guys, this could be a question in the state exam. This could be a question. It says, hey, a couple has a combining gross income. In this case, they said monthly. Sometimes they say yearly. You have to divide by 12 if they say yearly. But this couple has a combined monthly gross income of $12,000, and the lender's maximum income ratio is 28%. Now, quick note. This lender's maximum is 28%. Another lender's maximum might be 40%. Another lender's maximum might be 55%. So every lender determines what's their safe ratio. A typical ratio is 28%. So this question says the couple has a combined monthly gross income of $12,000 and the income ratio is 28%. What is the maximum mortgage amount that they can qualify for? What is the maximum PITI? Well, if they make $12,000 monthly, right? So gross income, right? And the bank is charging a ratio or DTI of no more than 28%, right? Then 12,000 gross income times 28% says that the max principal, interest, taxes, and insurance cannot be more than, so that's the max, cannot be more than 3,360. So this is how you figure out how much the lender will qualify you for, based on how much money you make and whatever ratios they are currently approving that particular lender. You figure out what's the max that you can afford. Now, let me just give you a heads up. I don't care much about this number. I care more about what the client can afford. What the bank tells you is based on their guidelines. This is what we'll go for, right? Because some banks could give you 43%. Sorry. 43%. And if we have 43%, right? So it's 12,000 times 43%. That means your maximum mortgage is 5,160. Okay, this is just an example. 5,160. So it's a big difference, right? Being approved for $33,000 versus $5,000, right? Is $12,000 the amount of money that we bring home? No, that's the gross. So the amount of money we bring home might be $8,000 as an example. So now I get a $5,000 mortgage. I bring $8,000. There's only $3,000 left. With $3,000, we still have cars, right? And this is a couple, so they might have two cars at $500 each, let's say, right? Plus insurance. So let's make it $1,500. Let's cover it all. We only have $1,500 left. You guys understand? With $1,500 left, there's utilities, there's food, other expenses that might show up, emergencies, right? I know Felix is typing, so I'm giving enough time. Something got into my eye. But anyway, so it starts cutting down. So this number is not what I want to know. On the lender standpoint, yes, I want to know that they're comfortable. On the client standpoint, I want to ask, Mr. Client, Mrs. Client, is this something you feel you're comfortable with? Is it something you can afford? Right? That's what I want to know. How much are you looking for to pay monthly? If the bank approves you for higher, great. But I'm going to look for houses that meet your budget. Are you guys understanding? This number is great. It's like a statistical, right? It's not the real number that your client needs. This just tells me, if I'm a realtor, just tells me I'm going to find a house that's like $600,000 and my client doesn't even want a $600,000 house, but I'm going to push it. Hey, the bank allows you, so do it, do it, do it. Don't do it. This is a stress test. Whatever they approve you for, that pre-approval is a stress test. What does that mean? It's the max that you can afford according to their ratios. The max, it's that pushing to the limit. right? They tell you pre-approved for $500,000 house. Let's look for $400,000 houses. I want to make sure you're comfortable. They tell you they approved you based on a $10,000 tax. Let's look for $8,000 tax property. I want you comfortable because I don't want you a year from now calling me and say, Bruno, I can't do this. I need to sell my house. Taxes are too high. Expenses are this, expenses are that, and this keeps on changing. Right? I don't want that. I want you to call me back a year from now and saying, I love the house that I'm in. The payments are amazing, and I want to buy another house. You guys got it? Look at the long run. Never what's right in front of you. Don't make the mistakes that most people make. Most agents make. Felix, can the bank go against the FHA rule by increasing the ratio? Since FHA ratio is 28%. FHA ratio is 31%. Okay? But there are exceptions. This is the typical ratios. There are exceptions. And yes, can the lender stress a little bit more? Because the lender might sell to different banks later on. And I'll talk about that better on Monday. It's called secondary market. Because they can sell. They have their own guidelines as long as it doesn't go against FHA. So they have... It's whatever the bank guidelines are at the moment. So the exceptions are created. I'll give you an example. The minimum credit for an FHA loan is 620. You have to have at least 620 points on your credit score to get an FHA loan. But recently, FHA went back to what happened in 2006, 7, and 8, where they allowed as low as 580. So once in a while, there are different programs that allow even lower credit score and even higher DTIs. You got it? So it's not you, it's not me, it's not the bank. It starts with FHA and what programs they're changing within the FHA. And then there's other government incentives aside from the FHA that the bank might take advantage of and allows you to buy the property with higher ratios. So there's a lot of things at play that really, those are the things you don't need to know. It's the loan officers that need to know, and even they don't know exactly how it is, right? They're given a sheet. Loan officers are given a sheet. Hey, these are programs we have now. This is how it works. Run with it, right? So not even loan officers know all the mechanics behind these exceptions or changes, right? They should, but not even they know. Okay. So we have the income ratio, which is the front end ratio, and then we have the back end ratio, which is called debt ratio. Now the debt ratio is the PITI plus other debts. So straightforward, we have the front end ratio, which is the housing expense. Sorry. That was this one. This was the housing expense. What is the maximum mortgage you can afford? The back end ratio is calculated to figure out what's the max that you can afford, including all the other debts. So maximum mortgage plus all your debts equals the back end ratio or debt ratio. So here's an example. And again, this could be a question. So an FHA-backed loan, the debt ratio may not exceed 43%. So front end 31, back end 43, right? So what does this mean? If we're using the traditional 36 debt ratio, the same couple that makes $12,000 a year, a month, the same couple, right, cannot have an obligation of more than $4,320. How do we figure that out? Again, your gross income times the back end ratio or debt ratio, right? The max PITI plus debts cannot exceed 4,320. So if your cars are $1,000 between two cars, because it's for the couple, $1,000, then we're at 3,320, correct? Yes? Right? 4,320 minus $1,000 just for the cars. That's the other debt we have. Forget credit cards, right? That's 3,320. If 3,320 is after deducting for the cars, is this higher or lower than this one? Remember, back-end ratio was with the cars. The max they'll lend to you is 3,320 for housing. But the max they'll lend to you for housing and everything else, considering housing and everything else, is 3,320. So this number right here is lower than the front-end ratio. So that drives your mortgage to this lower number. If you have credit cards, let's say it's $1,000 for cars, and then you have $300 on minimum monthly obligations for credit cards, right? Then it brings this number down to 3,020. That means that the maximum mortgage you can afford is 3,020. Are you guys understanding? They will calculate the lowest number, and that's what they'll approve you based on. So as soon as you start telling them, hey, I have this car, I have that car, I have these credit cards to pay, all that goes into calculation and reduces the front-end ratio by whatever the difference is on the back-end ratio. You guys understand that? Let me know if you have questions. No? Okay, let me go here. Okay. Let's assume the ratio is 28:36, right? So we have front-end ratio, which is PITI housing expense, and we have back-end ratio, which is PITI and other loans, right? This is from your gross monthly income. Okay? If you make $10,000, so let's keep numbers simple. If you make $10,000 gross monthly income, the maximum mortgage you qualify for is $2,800. That's the front-end ratio. The back-end ratio is the maximum mortgage plus car plus credit cards cannot exceed $3,600. Cannot be more than that. So if you think about that, if you think about that, $3,600 is really the max for all the debts combined, right? That's the maximum for all the debts combined. If you have $1,000 in car expense, let's deduct $1,000. That brings you to $2,600, right? That means the maximum mortgage that you can afford, PITI, is $2,600 instead of the original $2,800. Because in this second number, they're calculating everything. Here is the pure, you have no debts, no obligations, no nothing. This is the max we can approve you for on a monthly basis. That's the max mortgage, PITI, you can pay. In this one is, oh, you have a car? You have credit cards as well? All right, we need to factor those in, right? And that's, we're going to deduct that. from the max. So the max total between all your debts, and we're not talking about groceries, we're not talking about utilities, we're talking about debts, financial debts, right? So the max that we would approve you for is $3,600. Let's take the cars. How much is left? $2,600, right? Then that's as much as you qualify for your monthly mortgage, right? The more you owe in cars, credit cards, and whatever reduces your ability to get the mortgage. So now instead of a $300,000 house, you're getting a $250,000 house. You understand now? So it kind of reduces. The more obligation you have, so let's put it this way. More or less, for every $60 of monthly obligation, for every $60 of monthly obligations, it equals $10,000 loss in purchasing power. Okay? So, if you have a car that you pay $600 a month for, you just lost $100,000. So instead of buying a $500,000 house, you can only buy a $400,000 house because you have that $600 a month obligation. You got it? Did you guys understand? So for every monthly payment you have, credit cards, cars, anything that's financial debt, loans, other loans, for every $60 you have in obligation there, more or less, you are losing $10,000 in purchasing power. Okay? How do we calculate the loss from the monthly payments? What do you mean? You're talking about this loss, or are you talking about the loss that I calculated here? Oh, this $10,000 is an estimate, but it's around this. It's like statistically, that's what it is. So this is just a number thrown. So it's 50 something, almost $60 a month. For every $60 a month you have is equivalent to $10,000 loss in purchasing power. Simple. So if you have a $60 a month obligation, instead of $500, you qualify for $490. You have $120 a month obligation, instead of $500, you qualify for $480. And for every 60 on top, you're losing $10,000. You have $1,000, like I have a friend of mine that pays $800 something for his car, right? So do the 800, right? How much is he losing? Okay, so that's the math that you have to do. $800 divided by 60, 13 times 10. Because he has that $800 car, he can afford $133,000 less of a home. You got it? And then on those $800, I'm going to add credit cards. $200 worth of credit cards. Sorry. I'm going to add revolving loan of $350. So now we're at $1,350 monthly obligation, right? Divide that by that 60 number is $2,250 times 10,000. For every $60, you lose $10,000 worth of purchasing power. So my friend, for instance, just lost the opportunity to buy a house worth $225,000 more than what he qualifies for. Good? So yeah, that's why having expensive cars really make no sense. Right? This is the average car payment. You just lost $100,000. Felix is like, oh, there goes my Mercedes. Yep, get rid of it. This guy has a BMW. And he was my student. And he didn't care. And that's why he can't afford the house that he wants. The car was more important. I'm not a show-off. I don't like about bragging, oh, I have this car, I have that car. Right? I prefer to be able to buy more houses. And if $600 hurt me this much, right? In a nutshell, the less obligations you have, the more likely you are to get a higher amount of qualification. Yes, bingo, Yahtzee, you got it. Bruce Almighty, I'm sorry. But yes. That is exactly it. All right. Anybody has questions on this before I move forward on the ratios? Are we good with ratios? Give me a thumbs up if you're good on ratios. Great, great, great. Awesome. Again, review. I also have a couple of videos on YouTube regarding the whole financing chapter, so make sure you check it out. Cash qualification. So we talked about income. Now it's cash qualification. You guys know you have to have a certain amount of money in the bank. It's not just saying, hey, I have the down payment money. That's not enough. You have to have also reserves. You also have to have money for closing costs. So false advertisement happens all the time where people say, hey, you only need 3.5% down payment to buy a house. Not true. You need a 3.5% down payment towards the loan. To buy a house, you have closing costs. Now, closing costs might be negotiated with the seller and be reduced down to zero maybe. But to buy a house, you need your down payment plus closing costs. And the lender wants to make sure you have stability. So they want to make sure you have 3 or sometimes 6 months worth of monthly payments. So if your monthly payment is $2,000, you need to have your down payment, closing costs, and $12,000 worth of reserves in the bank account. So all that needs to add up. Do we have that money? Sometimes we don't. Can somebody gift that money to us? Sure they can. It could be given from a relative or friend or even your boss. Your boss, your employer can gift you the money. But it has to be a gift and with lack of any requirement to repay the gift. Okay? So if you're going to buy a house and you don't have the money in the bank, but you have somebody that can gift you the money, they have to sign a document that says, this is a true gift. We are not expecting, or I'm not expecting you to pay me back. Okay? So friend, relative, they can do that. Also, I'm going to address the question before somebody asks, because I had that question before. Yes, that friend is going to have to prove where the money came from. They cannot just gift you money without proving. It cannot be under the mattress money. It has to be in the bank money that's being transferred to you. And you and your monies also have to be there for at least 2 months, 2 or 3 months in that bank account. So yeah. Nina, do bosses normally do that? Do relatives normally do that? Do friends normally go like, hey, how much you need? 20,000? Sure, let me just get my checkbook. Here. No, people normally don't do this. No, of course not. But you have the possibility of doing it this way. Yes, we do work with a lot of people that gift. What you guys do behind the scenes, personally, I don't care because you're the one that's going to get in trouble. But do I know of people that gift and say, hey, just pay me later on the side with no track? It was a gift, right? Does that happen a lot? That, yes, happens a lot. Can the boss give you money and then maybe they'll deduct it from your paycheck? Technically, they can't do it because then it's not a gift, right? You understand? So I'll give you an example. My grandfather purchased a house in Portugal. Well, it's now 30 years. Yeah. So 30 years ago. Actually, 34 years ago. He purchased a property in Portugal. And his boss gave him a bonus. And that bonus was used to buy the house. So he really liked my grandfather and all that he did for the company. So he gave him a bonus. And that was enough as a down payment to buy the house. So do bosses normally do that? No. Right. I also worked for a boss of mine that my first actually employer, like real employer, he was constantly giving me cash bonuses almost every other month because of what I was doing for the company, the performance. He gave me a car. He gave me a cash bonuses. I was making like at the age of 18, I was making 5 times minimum wage in Portugal. None of my friends were getting even close, the ones that were working, getting even close to the amount of money I was making back then. So yes, it could happen. It could happen that you get these things. Is it normal? No. Okay. Next, they're going to check what your net worth is. So that's one of the things that goes into the calculations, your net worth. So net worth means your liquidity. So they're going to check how much assets you have. So the houses, cars are depreciating assets, but they might calculate it at a percentage as well. They see how much money you have in your bank account, so those reserves that I said. If you have any other type of monies that could be presented, like stock, that could be easily cashed out, they put a factoring ratio to that as well. And they figure out if you were to cash everything out today, how much money are you worth after liabilities, right? That's your net worth. You already know they check your credit report and credit score. And there's a big difference between credit report and credit score. See, you could have a history of 1 year and have a 680 or 700 credit score even in your first year. But your credit report doesn't have enough history for me to give you a loan on a house or on a car or something like that. Does that make sense? So just having a number is not enough. We need to analyze what your current debts are and how old are they. I don't know if you ever applied for a loan, for a credit card or anything like that, and they sent you a letter that says, hey, not enough history. Shows you the score. It's a great score. It's an approving score according to standard guidelines. We don't have enough history for that type of loan. Did you ever receive a letter like that? Or seen anybody that receives it? Right? Sometimes they say, hey, serious delinquencies, or your limits are too high, or whatever reason might be. This is one of them. Not having enough history hinders your ability to get a loan. Would it be better to disclose all the money, even if it's separate accounts, for example? Alondra, these questions. So, if you're trying to get approved for something, right? Yeah, you should disclose the money that's in separate accounts. Yes. Okay? It's just like doing your taxes. When you go do your taxes, they want to know about all the monies, not the money that's in this account. They want to know all of it. But again, depends on the type of loan you're trying to get to. So sometimes you just need enough for that. Okay? Anyway. As I was saying, if the lender denies the loan, they have to explain why they denied the loan. They have to say, hey, serious delinquency, not enough history, credit score too low, whatever the reason might be. They have to let you know exactly why. So they must disclose. When the lender then underwrites, you guys already know underwriting is risk assessment. When they underwrite, when the lender underwriters have a qualified applicant, so hey, congratulations, you qualify, then the lender has decided to offer the loan. The lender gives the applicant a written notice of the agreement to lend under specific terms. This is called a loan commitment. And a loan commitment is a written promise that pretty much says, congratulations, you are approved based on your current financial conditions. Meaning, do not change your current financial conditions. When you have this firm commitment or lock-in commitment, whatever it is, when you get these commitments, make sure you let your client know. Do not use your credit cards. Do not change the DTI ratio. Do not apply for a car. I just showed you guys, right? For every $60, you lose $10,000, right? So if you apply to buy a car, hope, you know what? I just got applied for approved for a $400,000 house, right? What's the problem in getting a $40,000 car? The problem is the $40,000 car costs you $600 a month. So that $400,000 house that you got approved for is now $300,000 house. If we're in the middle of a contract to buy a house that's $400,000, $380,000, $350,000, whatever, if we're in the middle of that, the bank will verify your information last minute right before the closing. They will verify your credit. They will verify your employment. If anything changes, like a loss of purchasing power, do you think we're going to close, guys? No. Okay? They will lend to you as long as that does not change. Okay? As long as that does not change. So whatever you start with, let your client know. Do not use credit cards. Do not sign for any loans. Do not lose your job. Do not change jobs. In fact, don't breathe over the next three months. Please. Do not change. This is you. Stay right here next to me. Don't go anywhere. Don't sleep. Stay with me. All right? Jacqueline is shaking her head. The point is, it doesn't matter how many times I tell this to my clients, and I have somebody that was my student, and I just heard about a month ago, a month and a half, my student goes, oh, I didn't know it was going to affect my credit. I'm like, I said, listen, when we sat down, so forget the school, forget I told you this in chapter whatever, right? So the other book was chapter 14, but forget I told you that in chapter 14. We sat down when you were willing to buy a house, and I explained to you, congratulations on your pre-approval. Do not use your credit cards. Do not sign for a new car. Do not change your employment. Didn't I say that? Yeah, but. No yeah buts. Come on. It doesn't matter. It's like the kids. You know how kids are, right? We adults do the same, just at a different scale. The kids are like, you say, hey, don't touch, and they're like, and they touch, right? And they touch. You say no, and they do it. So make sure you're on top of your clients with this. Do not change your current financial conditions. Very, very important. After closing, you want to buy a car? Go ahead. After closing, you want to change jobs? Go ahead. After closing, you want to buy furniture? You want to buy material to fix the house or change the house, whatever? Okay. After closing. Until closing, I cannot stress this enough. Do not change your current financial conditions. Is this clear? All right? I'm going to send you a reminder every week, okay? For you to tell your clients, don't change. All right. Next. We have a firm commitment. Again, it's that straight offer. Lock-in commitment. Every time you see lock-in commitment, that means they locked the rates. So in this case, it's a specific interest rate. So let's say you got pre-approved today, right? And the interest rates currently are 3%. The lender says, hey, you're pre-approved for a $300,000 house for a loan of 30 years at 3%. This commitment is valid for, as an example, 60 days. That means they're locking the interest rate for 60 days. If interest rates go up, you are protected, right? Because 3% is the lock-in commitment. If interest rates go down, it sucks for you, but you're locked in at 3%. Does that make sense? So lock-in commitment is a safe haven in case interest rates go up. You have any questions so far? No? Okay. So we're going to close the loan and then we're going to close the class, okay? We get halfway and we close the class. So closing the loan. Wait, closing the loan. Does that even make any sense to you? Do we close the loan or do we close on a house? Helder's like, I don't know. You tell me, you're the instructor. Do we close the loan or do we close on a house? Let me know your opinion. Jacqueline is funny. I told her about right now about don't change your financial conditions. She ran away to go tell people, listen, if you got approved, don't change anything, Bruno said. She just got back for the closing the loan. Guys, let me know. Do we close on the loan or do we close on the house? What's the deal with this? What's the deal with closing a loan? Close on the loan, closing the process to get a loan, okay. Closing is in the house. Vanessa says close the loan and close the house. Okay. Can we open the house? All right. So Vanessa is right. And so is Nina. Yep. Nope. It's very simple, guys. There's two closings. If you have a loan, there's two closings that happen the day of the closing. There's the closing of the loan where they disperse the payments, right? And once we have the money in the escrow account, the attorneys and the title company look at it. Okay, money's there. We can now exchange the keys for the money that was received. If it was a cash transaction, then there's no closing of the loan. It's simply, hey, here's cash, right? We wire the money, not a bag full of cash anymore, but we wire the money and we receive the keys. But because we're pending a loan, the bank needs to send money to the escrow agent, so whoever is going to close, right? And then once that is done, we have what's called the clear to close, and we move to the actual closing, which is the transfer of or conveyance of the house, all right? Is that where they get open house from? No. Open house just means the doors are open for anybody that wants to see the house and put an offer on the house. Open house is literally just an event where anybody can come in, right? So closing on a loan. Closing of a mortgage loan normally occurs with the closing of the real estate transaction. So it's both at the same time. At the real estate closing, the lender typically has deposited the funded amount with an escrow agent. So they wire the $300,000 along with the instructions for dispersing the funds. The borrower deposits the necessary funds with the escrow agent and then executes the final documents. So the actual closing, we sign everything, we receive copies, each one of us, and then the title to the mortgage property is then transferred and recorded according to legal procedures in effect at the time of the closing. The borrower receives a package containing copies of all documents and relevant transaction. So, two closings if there's financing. Closing of a loan is the wiring of the money to the escrow agent, and then closing of the house is signing the document saying the house is now yours because I did receive the money. Good? Got to remember, there's two closings involved if there's financing. You guys good? All right, Nina's coming. I know. As soon as Nina disappears, she's like, I'm telling you, ninja. The whole mask and everything, she's ninja. She disappears off the screen. I know a message is coming through. Unbelievable. Thought you had the questions ready. Just copy paste. Come on. Let's see. So if you buy with cash, you only close on the house. We don't close on the house. We close on the real estate transaction. But yes, that's the same thing. If it's cash, then there's no closing of a loan because no bank is involved. So the closing of the loan means the bank needs to wire money, and once the money is there, we're clear to close, the actual closing. Any other questions? Felix. No. So when we say cash, that means there's no loan involved. But cash will be a bank wire. So if you have $300,000 in your bank account right now, that is considered cash for closing purposes. So you're wiring directly from your account. It's liquid. It's available. It's cash. Yeah. We don't walk around with bags full of money. No. Long are the days. Nope. Imagine showing up with a black bag full of money. Forget the duffel bag. With just black plastic bag, garbage bag full of money. All right. Questions? Going once. I don't see question marks. So going once. Going twice. YouTube is not asking questions. Zoom, no questions. All right, guys. So with that being said, if you're joining me in the evening, I'll see you at 5:30. If not, then I'll see you on Monday at 10 a.m. Nina? No. 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 Nope. 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 I already closed. I see her disappear. That's it. Oh. I didn't know it was the end. Well, now you know. If you have a question, go ahead. How much more can I know? Do I have to have like a plaque that says, hey, the end? Is that what I have to do? Like, if there's no questions, the end? And Vanessa sings. Okay. That's your question? I'm here holding on to this, a question that could come right in the morning with the other 30 questions you asked. Can you take the school and state exam on mobile? The answer is no. Nope. Nope. Got to be on a computer, and he has to record what you guys are doing. So no, cannot be on mobile. All right. The end. All right, guys. If there's no other questions, then I'm going to let you guys go. Have an amazing weekend. I'll see you tonight if you join us. If not, then on Monday. Ask me questions. Send me questions. 908-418-8325. Send me questions on WhatsApp as you are studying, okay? And Felix, yes, chapter 14 is cool. All right? So you just send me a message separately. All right, guys? I'll see you.